listening to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy-Byrne.
Hey, everybody. Welcome back to another episode of the Daily Gold Podcast. Thank you so much for tuning in today. And with me today, he's a brand new guest. He's Jared Dillian. You may be familiar with him and his work. He writes for the Daily Dirtnap. He is the editor and publisher, and he also writes a Substack with comments on a number of things. Very interesting. He's a prolific writer, and I've been following his Twitter for the last month or so. Really liked what he had to say, and think he can provide our audience value. So, Jared, thanks so much for coming on. Appreciate it. How are you today?
Doing good. A little worn out by this market, but trying to stay busy.
Yeah, well, here in Goldland, we're obviously tech guys and regular market guys. They're taking it on the chin, but if you're a gold guy like we are, you're taking it in the nuts, not on the chin.
Yeah, I mean, I've had gold for 17 years. I started buying gold in 2005, and I started out at about 20% of my portfolio, and then it became 30%, and then it became 40%. Right now, it's about 40%. Yeah, I mean, the last couple of months, since the Ukraine invasion, have been super discouraging. I don't know. It's one of these things where it's the only thing left that you have to hold on to is faith, really. And if you're like me and you've been in gold for 17 years, you've been through this before. I mean, you went through this in 2012, 2013. You went through this in 2008. 2008 was a great example. When Bear Stearns blew up, that was March of 2008, and gold topped at 1,000, and then in the middle of the financial crisis, it was trading for 700, and people could not figure it out. And that was a 30% drawdown. I mean, right now we're at like a 13% drawdown, and people are suicidal. So if you've been investing in gold for the long term, it's definitely been worse than this.
Right, and I make the point that given we have rising real interest rates recently, the dollar has gone through the roof, and if you look at those should be negative fundamentals for gold, and they are. But if you look at, for example, 2016 to 2018, when it had a correction, you look at 2013, real interest rates, at least looking at the real tips yields in the last year or so, they've gone up more than at this point, they're up more than they've done those other two times. Gold got crushed those other two times. And now, like you said, it's only 13% off the high. I know a lot of us, in my world, we're into juniors and silver and leverage plays, so we're getting hit much worse than that. But nevertheless, gold, I agree with what you're saying. It's holding up really well given these negative factors out there with respect to the currency and real interest rates. But transitioning from that, I think, because I saw your tweets, and I think we might be in agreement here. And I've been saying this for the last 2 months, although I didn't expect gold would have this big drawdown the last month or so. It looks to me like, gold is going to be stuck, but when the Fed stops and they have to shift, that to me is when gold could really take off. Do you share the same view, or do you see things differently?
No, I share the same view, and I think the Fed is going to stop. The Fed, this Fed is not Paul Volcker. They don't do what is right. They do what's expedient, and things have not changed. The Fed is acting very tough on inflation, but really the only reason they're acting tough on inflation is because there is political pressure on them to do so. They should have recognized, about midway through 2020 that there were inflation pressures building. They have 400 economists, and this whole thing about how they didn't know it was coming is nonsense. They absolutely knew it was coming. There was just no political pressure to hike rates until inflation got to about 6 or 7%, and then people started to panic. Well, what's going to change is that people are starting to panic about stocks. I saw On Twitter, that what's happening thing over on the right. So Representative Jim Jordan made a comment about how your 401k used to be better under Donald Trump. I mean, but that's the beginning. Like, you get stocks down 20, 22, 25%, and people are going to start panicking about stocks. You get some of the economic data that start to roll over. This Fed fears recession way more than they fear inflation. So for sure, when this starts to happen, first you'll see it in the speeches. You'll see some speeches where they start to dial back expectations a little bit. But I think, the Fed funds market is pricing in about 3% Fed funds in early 2023. I think there's no chance of that happening. I'd be surprised if they get to 1.5.
Yeah, I mean, I completely agree with you. Something I wrote about, I think, earlier in the year is when the narrative, at least, politically, when it's going to when is the average person going to be more worried about recession than inflation? Or maybe it's just, it's like they're getting hit twice, because when they're worried about recession, they're still going to be worried about inflation. That's pointing a little bit to what you're saying with Twitter, which is like real-time information. Could you expound upon that point with respect to maybe when recession will overtake inflation as the main concern?
Yeah, I mean, I'm looking at ISM. ISM peaked around 62. Now it's about 55. What you're going to start to see is construction spending go down and durable goods orders go down. The Fed is going to, they're going to ignore it for a while. But really politically, what it is for the Fed is unemployment. So we printed 3.6% last time. The unemployment data lags the economy by a lot. Say we get a couple of ugly payroll numbers, unemployment ticks back up to 4%. I think that's when you'll see some movement out of the Fed, and they'll start to slow things down.
Yeah, now let's talk about the bond market, because you've had some great tweets about that in the last couple of weeks, and I tend to agree with you. And also let's lump in commodities, because commodities have been red hot. But if you look at the sentiment data, like the Merrill Lynch Fund Manager Survey, I noticed that pretty much something like a net 75% of managers were underweight bonds. I mean, just unheard of. And everybody was almost all in on commodities. I heard you ask this on Real Vision, but what's any idea what could be the tipping point? I mean, or does there have to be a tipping point? Because yields have been screaming higher. I mean, what's going to stop this or reverse this trend where we have commodities on fire and bond yields rising sharply as well? What's going to tip that so it reverses course, or at least stops rising?
Well, I think it is tipping. I think yields are topping it. I mean, I'm long bonds. I bought a bunch of bonds a couple of weeks ago, and I'm kind of flat on them, maybe down a little bit. But yeah, I mean, I don't know when you're going to publish this podcast, but just today, bonds are rallying across the curve. 2-year notes, interestingly, the front end of the curve is actually starting to rally for the first time. Twos that are about 2.6. They were close to 3% before. What is the market telling you? I mean, the market's telling you that, the Fed's going to blink. What I've noticed in the last couple of months is that gold, bonds, and stocks are all correlated. They're all up on the same day. They're all down on the same day, which is very unusual. I've never seen that happen before. But it's all based on liquidity, and it's all based on the Fed. So if the Fed blinks and they start making some dovish noises, I think you would expect bonds, gold, and stocks to go up simultaneously.
Right. But do you looking further out, aside from the near term where it seems like we're probably going to get some kind of a bounce at some point, maybe not, but looking past that, do you see the S&P going into a full-blown bear market later? Maybe it already is in one, but assuming we get a decent, sustainable rebound here, do you see that eventually rolling over later in the year, or do you think that there's a chance that the market could maybe make one more high and the economy has enough juice to maybe extend this thing for a little while longer? I mean, looking further out, how do you see things for the market and the economy?
Well, you have to sort of differentiate between a bear market and a great bear market. And we've only had 4 great bear markets in the last 100 years. So 1929, 1974, 2001, and 2008. So that's when, great bear market is when stocks are down 50%. Now, we've had about 15, plain vanilla bear markets where stocks are down 20%. And that's what I think this is. I think this is a garden variety, plain vanilla bear market. Look, I don't think either of us believes that the Fed would allow stocks to go down 50%. I think there's no chance of that happening. The S&P is down about 17% as we speak. Could it get down to 20? Sure. It's not that far away. But I think we're a lot closer to the end of this downdraft than the beginning. I think it's going to be over pretty soon.
So that if you're right, then you think that markets could go to a new high then?
I don't know about new high, but I think that we could at least be in a range between 4,000 and 4,800 on the S&P for a long time. But I think we're pretty close to the low as we speak.
It's really nice to hear a nuanced view on that because, I know you follow Twitter, but it's like if you're following Twitter, it seems like, everybody, well, at least, what I follow, it seems like there's the view of, this market's going to fall apart or we're going to have a melt up. So it's nice to hear a distinguished view from the extremes. But because just one thought on the economy, and I'm not an economist, but maybe, some of the data is weak, but maybe you could make the argument it's, maybe the recession gets pushed out a little bit. Any thoughts on that per se? I guess that would potentially align with what your market view is.
Well, the economy that we have, it's on paper, it's running hot. We did have a negative GDP print, but that's a one-off. So unemployment is low. The economy is hot. All this economic data is pretty hot. But it has a lot of shortages and dysfunction, and it's really different from anything we've experienced in the last 50 years. You go to a car dealership and they don't have any cars. I'm building a house and the architect told me we had to order appliances 18 months in advance. Before we even break ground on the house, we have to order appliances. So it's a dysfunctional economy. And what it really needs to restore balance to it is a recession. A recession would actually be welcome, And the Fed doesn't see it that way. They see unemployment as the worst possible outcome. Politically, people losing their jobs, it's the worst thing in the world, which is weird because 40 years ago, if a recession rolled through and people got laid off, they were unemployed for a couple months, they applied for jobs, they got jobs, and everything was fine. Now when we have a recession, we give them 99 weeks of unemployment. We're going to give them universal basic income. People are going to be out of the labor force forever. It's it's like the worst thing in the world when people lose their jobs. So that's why I believe the Fed is always going to err on the side of inflation rather than recession, because recession to them is the worst thing in the world.
Right. Now, circling back to gold, I don't want to put words in your mouth, but if you think that gold is at some point in the next couple of years could have this moonshot as it, breaks out of this super bullish cup and handle pattern, that's my editorial comment. But if you're of that school of mind, what do you think will be the narrative when it does that, or a narrative that could cause that, or maybe you just think it will make a huge move and the narrative doesn't matter?
That's a really good question. I don't know the answer to that. I think about that a lot. Gold trades very technically, and it kind of rallies when it doesn't make any sense, and it sells off when it doesn't make any sense. So, all I know is it broke out of a 2-year wedge pattern, and it was a powerful, impulsive breakout. We've retraced, but I still think we're in the breakout phase of that consolidation pattern, and I think that lasts for a couple years. So, the cup and handle that you're looking at is the same one that I'm looking at and everybody else, and I think it works.
Okay, yeah, I think we've covered a lot here, but and I thank you for coming on, Jared. But before I let you go, can you just judging or asking you a question regarding one of your tweets? So, Swingers is that your favorite movie, or that to you that's the best movie of all time?
I got to tell you, so Swingers is not my favorite movie. My favorite movie is Interstellar. Swingers might not even be in the top 5, but it's a very special movie when you know the whole story about, the budget for that movie was $800,000 and it grossed $80 million, so 100x returns. When you learn about how that movie was made with Jon Favreau and Vince Vaughn, it's an incredible story. And what's funny is it holds up over time. So that movie was made in 1996, and everything is different. Nobody had cell phones back then. The whole plot of the movie revolved around an answering machine, and that movie still holds up. I showed it to my nephew a couple of summers ago. Now it's his favorite movie, and he's 24 years old. So it holds up. It's really good.
Yeah, no, I'd have to agree with you. I don't know if it would be my number 1, but maybe in the top 5. It's really outstanding. Yeah, I agree with you on that. Well, on that note, Jared, thanks so much for coming on. Really appreciate it. And tell our listeners how they can follow you on Twitter, where they can go to follow your work.
Yeah, Twitter, I'm at Daily Dirtnap. Just look up Jared Dillian on Twitter. I have a free Substack, which is mostly for entertainment value. It's really good writing. It's called We're Gonna Get Those Bastards. And if you want to sign up for my market newsletter and, get my picks and stuff like that, it comes out every day at about 9 o'clock in the morning. It's called the Daily Dirtnap. You can go to dailydirtnap.com.
Alrighty. Thank you so much, Jared, for coming on. Really appreciate it. Love your views and analysis, and hopefully we can do this again over the coming months.
Yeah, for sure. Yeah.
Thank you for tuning in to the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.